Hey guys, welcome back to the Value Investor Show. Today, I'm going to talk about the stock that I'm seriously considering buying, and this might be the most overlooked stock in the market right now. No one's talking about it, but you definitely seen its products. You probably even worn them. So today, I'm going to show you a stock that has dropped 55% while its business itself keeps crushing expectations. That could be a rare moment where Wall Street is just flat out wrong. And by the end of this video, you'll see why I'm seriously considering buying. So today, we're gonna dive into a brand, a company that is flying under the radar and has two of the most iconic brands in footwear right now. And for today's episode, I'm gonna cover what is this brand, which brands does it own, and how are they performing, a full breakdown of their financial analysis, as well as why the stock has dropped 55%. And finally, I'm gonna go through what I believe is the intrinsic value using my tailor-made valuation model. So let's get started. Decker's brands own a portfolio of footwear companies, but two of them are doing the heavy lifting. Hoka, first of all, is the ultra cushion athletic shoe that runners and health pros wear by. And UGG is the lifestyle winter boot that you've probably seen 1,000 times over the last decade. You've probably seen social media influencers wear it. You've probably seen some of your friends wear it. Whereas Hoka is one of the brands that you've probably seen a lot of runners, professionals, health professionals, in fact, and fitness consumers wear it because it's very, very comfy. So Hoka is growing really fast, and it's built a loyal following in the space. On the other hand, UGG has been a brand for years. It has actually started in Australia back decades ago, and it has become a global winter essential. So when we think about the revenue breakdown of Deckers, we we think about, firstly, UGG makes up 51% of Decker's revenue. So it's the biggest contributor to the revenue for Deckers is UGG, followed by Hoka, which is roughly 45%, and then the remaining 4% comes from other brands. But here is the key thing. Hoka is growing faster than UGG, and I think very soon it's expected to become the dominant brand. Since 2008, in fact, if we look at the revenue, since 2008, Tech has been growing revenue consistently, driven by consumer demand, especially Hoka. Hoka has seen strong double-digit growth, and UGG has seen mid-teen double-digit growth. So this is a compound brand building story. Since 2008, Deckers has more than doubled the revenue from 2 billion, less than 2 billion, to almost 5 billion in 2025, and is expected to continue growing. Now, when we think about margins and net income, Deckers is a beast. They have a 18 to 19% net income margin. I mean, if you compare it to Nike, that is hovering around 6%, or other apparel and sports brands that, on average, sports brands have a net income margin of 8 to 10% at best. Deckers is performing way above the rest. And it's mainly because of that premiumness they sell with their brands. But that's not even the best part. The best part is that net income has been growing year after year, not only in absolute terms, but also in percentage terms. Now, they've just approved a 2.5 billion buyback plan, which at today's beaten down stock price is huge for long-term shareholders. That alone, at the current valuation, could mean a 15 to 20% returns just from buybacks if the price stays low. Now, here's the crazy part. Deckers is trading at its lowest P ratio in the last 10 years. Is the stock is down 55% since its highs back in February. So the stock had a great run up to February 2025, and since then the stock has basically tumbled down to less than 100 at some point 2 weeks ago. So let's say that again, a premium brand company with some of the best margins in the space, still growing, is down 55%. So if it's not the financials, if it's not the growth, then what is it? So before we dive into the what is it that has caused that drop, I want to go through something that no one talks about. Deckers is a company that over the last 28 quarters, so since 2008, have beat EPS estimates 26 times. So apart from the second quarter of 2022 and the first quarter of 2023, the company has beat earnings every single time. That's insane consistency. And I think that tells me that management knows what they're doing. They have lowered expectations for the next quarter, and I think that's because they want to continue with the outperformance and they want to beat the EPS estimate once again. So why has this stock dropped? Well, let's break it down. Number one is tariffs. Deckers sources 95% from Vietnam and 5% from China. With that being said, the CEO has said that there is a potential of 150 million impact due to tariffs. That has spooked investors, but with a caveat. The CEO has said that they expect to offset most of that with suppliers. And I think that they will absorb very little of that 150 million figures, with Vietnam being a great geopolitical spot for trade with the US and have already agreed a deal as well. Now, other Vietnam exposed brands like Nike, On Running have rebounds in terms of their stock price, but Deckers hasn't really yet. And I think that's driven by a few other reasons. The second one is the short-term revenue concerns. There's some weakness in the direct-to-consumer channels noted by the CEO, which is quite normal, especially with the softening US consumer spending. And one thing to note is that Deckers 35 or 40% of their revenue comes from the US. So the US is the biggest consumer segment for the company. And therefore, given the less consumer spending in the region, that's another key consideration that has spooked investors. Now, the third one is really freight costs and promotions. There's a slight margin headwind, but it's not structural. It's a slight headwind that will essentially be solved, and that's freight costs and promotions. And then the fourth one is macro demand risks. So any slowdown or any changes in consumer preferences could affect the company. But again, the historical precedents and how well positioned the company is right now does not justify a 55% sell-off. There's always short-term fears for all the companies, and for us value investors, this could be a viable opportunity to enter. Now, let's flip the narrative. Let's talk tailwinds, so opportunities ahead. Number one, this is a very healthy long-term brand. Hoka is a rocket ship of a brand. I own a pair as well. I run using my Hokas, and trust me, these shoes are amazing. They're built for runners. They're cheaper than other companies. And with the running market itself growing 7% year on year, Hoka just needs to capture just some of that market, and that will position the brand exceptionally well. The second one is the growth prospects. In a normalized environment, Hoka would be expected to grow in the mid-teens. However, with the current conditions, that might slightly be reduced. But with that being said, I still think there is a strong double-digit performance or growth with Hoka expected. Now, that in terms of management, I think the quality of the new CEO is definitely there. The CEO has a background at Nike. He climbed the ladder. He worked at Puma, and he climbed the ladder at Deckers as well. And they're transparent. They're disciplined. And I think one of the things that shows their discipline is their strong cash balance, as well as that the fact that they have zero debt. They have zero long-term debt, zero short-term debt, and it's something that's really unheard of in the space. Now, with the valuation, it really depends how much we price tariff risk. In my case, I do think that most of the tariff risk will be mitigated. But with that being said, we will go through the valuation in a few slides. But before we do, I want to show you visually the financial analysis or the financial metric snapshots. So, in terms of 10-year averages, they have strong revenue growth, strong net income growth, consistent EPS and free cash flow growth. Their profit margins are insanely well, as well as their gross margins. I mean, the profit margin on the 10-year average is 12%, but keep in mind the last 3 years is roughly around 18 to 19%, which is extraordinary. They have zero debt, they have massive buybacks coming, and in terms of return on assets, equity, capital, they are performing exceptionally well. I mean, the green indicates if the green indicates that they're beating what I would expect as a minimum for companies that I'm looking to invest, and this company gets an A plus in terms of how well those financial metrics look. Just to finish, I think the if we want to go through the intrinsic value, I have a bespoke model where I put together the historical and what I think would be the future estimates based on historical and as well as what the company has said. And I have studied the earnings statements, I've studied what the CEO has said. And with a discount rate of 10% and a margin of safety of 50%, I have estimated revenue growth estimates of 8%, which is for me a very conservative one, especially if we think about the historical revenue growth. EPS, I've put it at 10% because we have a push as well from buybacks, and free cash flow at 10% as well. And my average intrinsic value is at $108. So that compared to the current stock price, which is 107, it does show that Deckers is currently underpriced to its current value. And so my final thoughts is, if this story checks out, and I'm going to keep on reading about the firm and see whether I've missed something. But until now, there are no red flags. But I'm going to keep looking. And, if everything checks out, I'll probably start buying. As a value investor, I look for world-class brands that I understand, brands that I wear, and with strong growth, clean balance sheet. And I think Wall Street might be missing the story here, but there's still a bit of more research to do. Let me down on the comments below on what you think, and thank you so much for watching the Value Investor Show.